The February 2026 RBA rate shock. The Santa Claus deception. Welcome back. If you spent December listening to real estate agents telling you to buy now because rates were about to drop, you were being sold a lie. We are entering 2026, and the landscape has shifted violently. On December 16, 2025, the two largest banks in Australia, CBA and NAB, did something the market wasn't ready for. They tore up their rate cut forecasts and replaced them with a February third-rate hike. We aren't talking about a pause anymore. We are talking about a move to a 3.85% cash rate. This is a strategic pivot that will catch 85,000 first-home buyers in a pincer movement. You were told the mortgage cliff was over in 2024. The truth? 2026 is when the actual structural damage begins. Today, we are digging into the data that the mainstream media is burying. The inflation floor and capacity constraints. Why is Australia the global outlier? To understand the February hike, you have to understand the inflation floor. While global goods prices, things like TVs and cars, are getting cheaper, Australia's services inflation is stuck in a loop. Insurance premiums, rents, medical costs, and electricity are all hovering at 3.9%. The RBA's target is 2.5%. We aren't even close. The ABS September quarter data showed a trimmed mean inflation of 3.0%. And it's refusing to budge. But here is the part they don't tell you. Australia is running at its speed limit. Our GDP is growing at 2.4%, but our infrastructure and labor market are maxed out. We are trying to build 1.2 million homes while suffering from an acute skill shortage. When demand exceeds supply this aggressively, the RBA only has one weapon left: the interest rate hammer. We are going to analyze the exact CPI print coming on January 28th that will serve as the final trigger for this hike. The 182% debt-to-income nightmare. Let's talk numbers that matter. Australia currently holds a household debt-to-income ratio of 182%. For context, the U.S. is sitting around 101%. This is the single most dangerous metric in our economy. It means that for every $1 an Australian household earns, they owe $1.82. Why does this make the February hike different? Because in Australia, a 0.25% increase is twice as lethal as it is in America. Most Australian mortgages are variable or short-term fixed. When the RBA moves, your bank account feels it within 30 days. On a median $750,000 mortgage in Sydney or Melbourne, this February hike adds another $120 to your monthly repayment. That is $1,440 a year ripped directly out of your discretionary spending. This isn't just less coffee. This is the inability to service car loans and credit cards. We are looking at a 2026 where disposable income becomes a myth for the middle class. Who pays the price? The sandwich generation and arrears. Who is actually absorbing this cost? It's the sandwich generation, those aged 35 to 50. You have the largest mortgages in history. You're supporting children who can't afford to rent, and you're caring for aging parents. This is the group that the APRA data shows is already starting to buckle. Mortgage arrears, people 30 days or more behind on payments, have ticked up from 1.2% to 1.6% in the last 6 months of 2025. It sounds small, but in banking terms, that is a red alert. And there is a new rule coming in February 2026, debt-to-income limits. APRA is now capping banks, meaning if you wanted to refinance to save your home, you might find the door slammed shut. We are going to look at the refinance trap and why 2026 will see a surge in distressed listings in suburbs like Blacktown, Pakenham, and Logan. The January 28th countdown. This is the bottom line. The RBA isn't trying to help you. They are trying to save the currency. If they don't hike in February, the Australian dollar will collapse against a resurgent US dollar, making our fuel and imports even more expensive. Your move? Watch the January 28th CPI announcement. If that number is 3.4% or higher, the hike is 100% locked in. The 2026 property market isn't a get-rich scheme anymore. It's a game of liquidity survival. Subscribe now, because next week we are mapping the specific suburbs that are already showing a 5% price drop. Don't be the last one to know.